G'day everyone, my name is Hoi
My name is Hugh.
and welcome to Fin Chats. Now, today I've got a question for you, Hugh, and it's one that probably everyone has thought about, but not in maybe the same way that I'm going to ask you. So, lottery. We've all thought about winning the lottery, but if I was to ask you if you won $10 million today, would you take the $10 million upfront as a lump sum today? Or would you take it as a $1 million over 10 years?
That's a really good question, Oi, and I think I've heard this one before, but I reckon I would take the $10 million now. And I say that because, not because I'm greedy or anything, but because I think that uh, taking it now gives you a lot of opportunity and time for that money to grow, essentially. I think that I can park that $10 million in the bank account, even if it sits in my bank account, at least, it's actually going to probably be bigger than the $10 million that it's worth today. It's probably going to grow to some bigger value over time. I could use it to start a business. I could buy a house. I could do something with that money. That's the whole premise of why I think I'd do the
I mean,
$10 million.
you mentioned that it might grow, but as with any investments, as you would know, what can go up can also go down, right? So, wouldn't the $1 million per year insulate you a little bit from that, losing everything all at once?
I think that's a really good point, but I think you'd have to be quite reckless, to be frank, with your money to lose money over time. Because if you actually look at how the stock market has performed ever since it was created, it's probably generated returns 80% of the time. The other 10 to 20% have been because of, recessions and whatnot, but that's part of natural market cycles. So I think that there are a lot of risk-free and or risk, investments with less risk that you can park your money in. Um, yes, you're right that there is definitely a possibility of losing your money, but you'd have to be investing in some crazy stuff out there. Whether that be some esoteric crypto coin that might have blown up, called Dogecoin or Catcoin or whatever it is, or some risky venture.
What
But
did
then
you
if you
know? Did you know then, this might come as a surprise, because, I was reading some stats the other day that, at least in the US, 70%, can you believe 70%
wow.
of people who won lottery have gone bankrupt or faced financial trouble within the first few years. So, you know, it's not good odds. It's not a good odds when you look at
I, yeah, I
that
think it's not what I was when you think about it, but it's because if I imagine, the financial literacy is a big reason. They might not be, financial literate, or just might not know what to do with that $10 million. And it's quite easy to blow it away, whether that's on, fancy cars or yachts and whatever.
Yeah.
But if you just have a basic understanding of how, you know, money works, how interest rates work, how inflation affects your money, then more often than not, if you just have sound financial advice, you can easily allow that sum of money to grow over time.
Well,
So
I've got a feeling, isn't wanting the money up front just human greed? I mean, which one will actually, what I'm interested, Hugh, is which one will actually give me more money at the end of the day? And, putting aside, instant gratification that I want my money today, like which
uh,
one from a pure money point of view, numbers point of view would give me the most?
well, I'm glad you asked that actually, because this is actually a core principle that I think we should talk about. It's
Right.
called the time value of money. Essentially, the premise is that a dollar today is worth more than a dollar in the future, because it can and will, well, not will, but more likely than not will grow over time. So what I'll actually do is I'll just bring up a whiteboard just so I can explain this concept briefly.
Yep.
So, this concept of time value of money is quite foundational to how we price assets in the stock market or the bond market. Everything is sort of based around this key principle. So if I just get this pen out and start writing, so the time value of money, it's based on this formula. Now, I don't want any of our audience to be freaked out by this just because it's a formula. It's a very, very simple formula. And if we explain it in simple terms, you'll understand what it's trying to say. What it's trying to, well, the formula, I'll just write it out, is the PV is called the present value, and that is equal to some sort of future value divided by 1 plus R, and then that's compounded to N. Now you're thinking, what the hell is this, right?
I am.
But if I just bring out a timeline just to get things into perspective, your question was, will I rather take the money today? So let's just say today is here because it's a timeline, right? And then 10 years on, we are over here. Actually, it might be easier to write the dates out. So we're in 2023, and this would be 2033, right?
Yep.
Now, this P, it stands for present. So think about this belonging to there, right? And this F is future, which belongs here. And we want to make our money be bigger than it was today. So essentially, if we can rearrange this term here, we'll actually get PV times 1 plus R to the N equals FV. So what does that even mean in layman's terms? It's just saying money today will actually grow over time. So that time is N. N is just like the number of years, right? And then R is like the interest rate. So if you let your money grow over time at some sort of interest rate or return, it will come out to this future value, right? So for your money to be bigger in the future, it would have to grow at some sort of interest rate that is positive over some period of time. I have a very simple example. Let's just say we had $100 today and interest rates, let's just assume it's 5%. And if we let that grow over 10 years, as an example, right, I'll just plug in the numbers and see what we get. But essentially we get $163 compounded. Now, if you reduce any of those figures, if you reduce the R to 3% or 1%, and we let the money compound less over 5 years, so that would actually give us a lower amount naturally because both of those terms are lower.
Right.
So,
right.
That would probably be 116, which is much less than that 163. This is the core principle essentially of finance. And as I said, it kind of forms a bedrock on how, all these professionals in the market sort of price the value of a stock, and you might see Apple at, some sort of like, whatever it is, $300 or whatever, or Tesla at $800. They get all these numbers just by getting or calculating the present value of the stock by some future value. That's all they're doing. They're getting out all these streams of cash flows that they think they will generate in the future, and then they'll just bring it back to what they think it's worth today. So,
based on the interest that you might be able to get on your investment. That makes sense. So the higher the interest that you possibly can get, the higher the time value of money is. It's more valuable to you because you can earn right now at a high interest rate is what I'm understanding, right?
Yes, correct. Exactly.
Great. Okay, so I just thought it was your human greed that you wanted the money right now, but
No,
what you're
not.
explaining is, yeah.
Yeah. No, exactly right. So,
Right. So here's a final question for you, Hugh. If you really won the $10 million, how much would you give me, and what would you spend the rest on?
is it putting me hostage right now? I would say, look, let me give you half just to make sure
Okay,
that
okay, half sounds
Adult
good.
isn't jeopardized and our relationship is still intact. So let me give you the 5 mil. And then with the other five, I would clear all my debts because actually, interestingly, debts can actually work in the same way with this concept. It can actually compound over time. So what I want to do is make sure it doesn't happen. I want my assets to compound, not my liabilities. So
Right.
make sure I have no liabilities and I cut all those off. And then I'll probably use that money, to go overseas, work remotely, put 80% of that 5 mil in some sort of portfolio that would give me a constant stream of like dividends and interest. Um, and yeah, I think that it'd be really interesting to sort of live stress free, just work wherever you want to be. And, that's what the power of money can do. If you put in the right sort of investment and you don't risk your capital, it really can bring you a lot of opportunities. It can free up a lot of stress in your life. I think money is a means to everything. It's definitely important, but also at the same time, it doesn't define life. So that's what I would
Very.
do with the 10 mil. Give half to you and then do some sensible things with it.
I'll wait. I'll stand by my letterbox to wait for the check, Hugh. So,
Give it
so
a week or two.
that's all we have time for today. Thanks very much for walking us through the time value of money. If you like this video, make sure that you like, comment, and subscribe to make sure that you're up to date with everything to do with finance. And until next time, we'll see you later.
Right. Thanks, Hoi, and see you, folks. Bye.
Bye.